Hi, I'm Sam, and I want to tell you all about trade finance. And along the journey, this might even help your clients. Trade finance can be for anyone who has a finance gap between providing goods or services and actually receiving the final payment. Around 80 to 90% of global trade is reliant on trade and supply chain finance, which is estimated to be around $10 trillion a year. We want to help explain some of the concepts behind trade finance. Sometimes banks might not be the best funding option. We've seen increased regulation, reduced standard lending, and SMEs finding it difficult to access finance from traditional means. Does this have to limit you? Absolutely not. At Trade Finance Global, we help companies find debt funding. We're impartial, flexible, and work with most funders on the market to ensure SMEs really do get the most appropriate source of funding to help them grow. So what do we offer? In a nutshell, we offer business finance solutions through our network of lenders to companies. So, how does it work? A trade finance transaction requires a seller of goods or services as well as a buyer. A lender would come in and fund this trade. Trade finance is relevant where a seller requires the buyer to prepay for goods that are shipped. So, what's needed? As an example, the buyer wants to reduce their risk by asking the seller to document that the goods have been shipped. I'm going to show you one example of how a trade finance deal could work, although there are many different forms of trade finance. Firstly, the buyer approaches the funder because they want to purchase toys to sell on to customers. Once the funder assesses this and approves, they issue a form of undertaking to the seller. The supplier then ships the toys, invoicing the funder. The funder invoices the buyer, who then sells the toys to his customers. The buyer's customers, who could be a retailer, then make a payment. The buyer has fulfilled their part of the transaction, as the funder has received their funds and profits are kept by the buyer. Trade finance is the type of finance used by buyers and sellers to assist with the trade cycle funding gap. So, if you're a UK buyer purchasing food from abroad, you might use a trade finance facility to mitigate and reduce risk. Lenders who assist with bridging this finance gap take on responsibilities to ensure trades are safe, effective, and secure. These include controlling some of the financial elements of a trade, keeping a close eye on the trade cycle throughout the transaction, and ensuring the security of goods and debt, which is also known as receivable. What are the risks of trade finance? When trading goods, either the buyer or the seller will have to take on some form of risk. A seller who is producing the goods wants payment up front, whilst a buyer wants to pay as late as possible so that they can sell their products on to customers and may want to receive some form of credit terms. At Trade Finance Global, we know that standard forms of debt don't work sometimes, and most businesses are not keen to put up standard security such as their house. Instead, with trade finance, security could be a purchase order, future payments, invoices, or the goods themselves. So what are the benefits of trade finance? Using trade finance can enable a business to take on more orders and grow faster. For businesses, it can enable them to take on multiple work streams, employ more people, and grow quickly. Payment can be made in multiple currencies directly to suppliers depending on their needs. So why would a company need to use Trade Finance Global to get trade finance? Well, using trade finance allows a company to produce more working capital and improve the management of cash flow. Companies are able to fulfill large orders that would usually not be possible. They can achieve higher profit margins because a facility allows bulk buying of products and advance payment, which can be great for economies of scale. Relationships between buyers and sellers are strengthened. Profit margins and EBITDA may be improved. There is greater room for efficiency, as well as being more competitive in the market. Also, business owners can diversify the suppliers they work with and expand their network. There are fewer bad debts, late payments from debtors, excess stock, and this could all bring down the problems associated with demanding creditors. So what will funders ask for? We generally find that by having prepared the following, funders can make a very quick assessment and help your businesses get trade finance. Here's what you should be able to provide. audited financial statements, full business plans, financial forecasts, credit reports, details and references of the directors, and information on assets and liabilities. Thanks for listening to this talk on trade finance by Trade Finance Global. Be sure to check out our other training videos, which will be sent to you soon. Please do not hesitate to get in touch with Trade Finance Global if you have any questions. Thanks!